APL Apollo Tubes operates in one of the most traditional, heavy industrial sectors on the planet, manufacturing steel tubes and pipes. In the second quarter of fiscal year 2026, the company reported a revenue increase of 9.2%. For a legacy manufacturer, that is a respectable standard growth rate. But this bar chart reveals a massive discrepancy on the bottom line. While revenue grew 9.2%, profit after tax surged by 460.4% in that exact same quarter. Statistically, this is an anomaly. In heavy manufacturing, you do not naturally yield triple-digit profit jumps from single-digit revenue growth. The costs of materials, labor, and logistics typically scale up alongside sales. To understand how they generated this excess cash, we must look at a financial concept called operating leverage. Operating leverage is a company's ability to increase top-line revenue without increasing fixed costs at the same rate. We are going to deconstruct APL Apollo's Q2 and Q3 profit and loss statements to isolate exactly where these margins are coming from, and then analyze how this cash is actively funding a massive physical capacity expansion. If this profit jump is a permanent structural change, it indicates APL Apollo has transcended traditional manufacturing constraints and engineered a highly optimized cash machine. Let's pull the raw inputs from the Q2 FY26 financial statements to see exactly how this happened. Total income shifted from 4,788 crore to 5,231 crore in Q2. But while income rose over 9%, total expenses grew by only 2.7% year-over-year. Sequentially, compared to the previous quarter, expenses actually shrank by 0.8%. The mathematical reality here is absolute. When you hold expenses flat while scaling top-line revenue, every new dollar earned falls straight to the bottom line. We begin with a baseline profit after tax of 53.81 crore from Q2 last year. Add the new revenue, subtract marginal expenses, and we reach a profit before tax of 386.36 crore. After tax, the final quarterly profit resolves at 301.54 crore. There is a counter-argument to numbers like this, known as the low base effect. Analysts will often discount a 460% jump if the previous year's quarter was artificially depressed by supply chain shocks or factory shutdowns. A bad prior year makes an average current year look spectacular. Because of this low base effect risk, a single quarter's data isn't enough. Investors have to look at sequential data over time to prove that this profitability is a permanent structural shift. To test the durability of these margins, we move to the subsequent quarter, Q3 FY26. In Q3, consolidated net profit reached 310 crore. Against a healthier previous year, that is a robust 42.86% year-over-year growth. The operational driver for this profit was physical sales volume. They achieved record sales, pushing out nearly 917,000 tons of product. This is where we look at unit economics, the direct revenues and costs associated with producing one single ton of steel. The correlation between pushing record volumes out the door and simultaneously increasing profit by nearly 43% proves their unit economics are sound. They are making efficient money on every extra ton without bleeding cash on operational bottlenecks. Looking at the 6-month trailing performance, we have Q2 establishing tight operating leverage and Q3 proving that the structural stability holds at high volume. But success at this level introduces an inevitable bottleneck: capacity constraints. Sequential profit stability on record volumes indicates the existing factory footprint is operating near maximum efficiency. To capture any further market demand, they have no choice but to physically expand. This transitions the analysis from financial modeling to the physical reality of manufacturing infrastructure. This step function graph charts their baseline at 5 million tons. To break this ceiling, Phase 1 targets adding 3 million tons within 24 months, reaching 8 million tons. This represents a 60% capacity increase. Phase 2 follows immediately, hitting 10 million tons by 2030. Executing this timeline effectively doubles the company's entire manufacturing capability within just 6 years. This is textbook industrial scaling. They are taking the highly optimized unit economics of their 5 million ton operation and using that cash engine to self-fund aggressive market capture. The APL Apollo playbook over the last 2 quarters comes down to a clear 2-step process. On the left panel, we see Step 1, ruthless expense control, squeezing maximum profit from the existing footprint. Step 2 is deploying that cash toward 8 million tons. These concepts operate as a unified engine, with operational discipline directly funding structural scale. The primary risk going forward is entirely operational. It lies in CapEx integration. Bringing 3 million new tons of physical capacity online over 24 months creates massive upward pressure on fixed costs. During rapid scale-up phases, heavy industrial companies routinely see the profit margins that funded the expansion diluted by new factory overhead and integration hurdles. For analysts monitoring this stock, the ultimate metric to watch is the expense sheet. Can the firm maintain its flat expense structure while spinning up the new Phase 1 factories? The ultimate 2030 target of 10 million tons is completely contingent on management successfully navigating this immediate 24-month high-wire act. If APL Apollo Tubes scales their footprint by 60% without breaking their newly established operating leverage, they will secure their position as a highly optimized, dominant player in the global steel sector.